Hello, ladies and gentlemen, this is your daily news and investment advice. And I want to say I'm so happy you guys decided to come back to my channel to listen and learn about crypto and stock analysis and all the breaking news you need me to help you succeed in your crypto and stock adventure to the top. And now, without any further delays, let's get into it. And before we start, please don't forget to like and subscribe. And if this is valuable information, please hit the like button and drop a comment because it really helps us grow. Today, I want you guys to take a listen to Cathy Woods and Josh Brown discuss inflation in America and what the Feds have planned and what they have been doing. I think this is a very interesting piece, and I decided to share it with you guys, so take a listen and tell me what you think.
The Federal Reserve had a lot of money out there. It pushed investors into riskier assets. And now we've seen it come back down. The Federal Reserve is tightening funds. You may not see money supply like that out there again. So it may take years for some of these companies to grow into the stock multiples or the stock levels that they had seen at earlier times. What do you think about that thesis? What makes you think we'll get back to those higher multiples?
Well, we don't need the higher multiples. So we have a 5-year investment time horizon. Just to give you a sense, for our flagship portfolio, our enterprise value, so that's both equity, market cap, and debt, enterprise market value to EBITDA, so effectively cash flow, is around 69 times. So I know a lot of people say profitless tech. We are not profitless on balance. We make the assumption that in 5 years, that number will be close to the market multiple on that basis, which is roughly 16 times. So in our models, and we're starting to publish our models because we really want people to understand this. We just published Zoom, we published Tesla. You can find them on GitHub. Experiment, change the variables we think will move the needle. And you can see how your assumptions might work into our 5-year investment time horizon. So we assume a 20% annualized headwind from declining valuations. And so our return expectation, which is quite substantial right now, is based solely on revenue growth and rising profitability. Now, the narrative you just gave, many people cite when they're talking about the tech and telecom bubble and bust. And we've analyzed our portfolio relative to that as well, because there are memes around that. It's astonishing to us that Zoom's revenue since the coronavirus is up roughly 6-fold, and the stock is almost down to where it was pre-COVID. Same with Teladoc, up 4-fold. Tesla up 3-fold, although Tesla has, now that it's in the indexes, it has held up better than the rest of our portfolios. But that narrative in 2000, if I could just say, it would suggest that by now we would be seeing negative revenue growth in our expectations for the next year and declining gross margins. We are seeing the opposite. We're seeing north of 25% revenue growth. If you're just using consensus estimates, it's 25. And our estimates are much higher because we're focused on exponential growth trajectories being driven by powerful new technologies.
Cathy, one broader question and then a specific stock question. When you think, though, about the last year and you think about your approach, what is the lesson in it? Meaning, I know you have a North Star about specifically these stocks that you're talking about, but at some level, you have to look around, and I think your investors would want you to look around and say, okay, I was wrong. What was I wrong about? And if I was wrong, how am I going to change my approach in the future?
So if we were wrong on one thing, and that was inflation being as sustained as it has been. Supply chain, I can't believe it's taken more than 2 years. And Russia's invasion of Ukraine, of course, we couldn't have seen that. So inflation has been a bigger problem. But I think that it has set us up for deflation. I've been listening to your program. I heard Ken Langone talk about being in recession now. Jeremy Siegel, same. We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career. And I've been around for 45 years. And we're talking about the best managed companies in the world. If you're talking about Walmart and Target, they know how to manage supply chain. So if they have problems, We think there are a lot more problems. And then the other thing that's going on is the consumer is railing against these price increases. Consumer sentiment, as measured by the University of Michigan, which we think is the best measure out there, is down to record low levels, below 08, 09, below 80 and 81. I had just started my career and inflation and interest rates were in the double digits, 15, 20%. And consumer sentiment today is lower than it was back then. And most interestingly, in the last report, many people think, oh, the heavy spenders will keep this thing going. Consumer sentiment in the highest income groups is lower than in the lowest income groups, and the latter group is being, tormented by food and energy prices, which are really a regressive tax increase here.
I think the question that I have is whether Jay Powell is right that inflation could come down rather quickly, and here's why it might. I'm doing a lot of reading, as I'm sure many of us are, on the bullwhip effect in supply chain management. And it does seem to lead to things like what we've got at Target, and Walmart for that matter, with just an oversupply of inventory, which is going to lead to cost cutting. And that may just be the tip of the iceberg. You put on top of that the cracks, and they're only cracks in the labor market, but people being let off at some of the beneficiaries of the pandemic. Sure, they're going to find jobs, but it's going to ease the pressure off of wage pressures. You put this all together, and Michael, I heard what you just said about, everybody's got their narrative, everybody's got their theme, people want it to be over, including me. But actually, there's some credibility, I think, to what I just said.
Well, including me, too.
Having said, we've got to see how it plays out.
Be careful what you wish for.
Yes.
Because if you get this rapid drop in inflation, it will be for one reason only, which is that the Fed has thrown us into a technical recession. And by the way, this is happening on a parallel track around the world.
Can I posit one thought? And maybe a quick, fast recession is exactly what we need.
Okay. I'm not saying it's the end of the world.
Right.
I'm not against it.
I mean, isn't that a natural part of the business cycle?
I'm not against it.
Recessions happen.
So we hit a recession. We had one that lasted a week in March of 2020. And it's interesting. For moral reasons, we decided, no, we're actually not going to have one. And every branch of government, every central bank around the world, Democrats, it's like the one thing in the last 10 years I can remember us all agreeing on, other than Gangnam Style, right? So you have two things the world agreed on. Gangnam Style is awesome, and we should not have a recession and ruin people's lives over a COVID lockdown. We all agreed, and we did that. But you have to pay at some point. You have to actually have that recession to cleanse some of the excess. And arguably, it would have been preferable to have done this last year rather than continuing to stimulate the housing market for no apparent reason. So we didn't do that, and we're doing it now. Okay, so is the worst thing on earth a technical, short, shallow recession? Definitely not. In fact, I would argue it's preferable to us pretending that we don't have to have one and then having a horrible one because we keep doing things to forestall it. So that's where we are now. I don't think the majority of people on Main Street would have their lives materially altered by a recession in this case because of how tight the labor market is. And if we lose a bunch of executives at Netflix, but we managed to keep very high employment among nurses, truckers, people working in oil fields, it's really not that horrible. So I think it's okay if we're headed in that direction. I think it's okay if it happens sooner than later. But again, be careful what you wish for on inflation coming down, because it's probably going to be as a result of the Fed throwing us in there. Last thing on this, we always overshoot. You cannot ever point to a single recession that we've had where the multiple, settled at an average historical multiple. I don't care what you follow, price book, book to market, price earnings, forward, backward. You ain't getting out of this thing at 16 times, especially if earnings estimates start to fall apart in the second half. So I'm not trying to come on here as the gloomiest person in America. I'm just trying to be real with people. Go look at the last bout of inflation from the early 80s and where the earnings multiple settled out at. It was like 9. It was not 17. You ain't getting 17 this time either.
It is a pendulum. We saw the pendulum swing very far to one side, and now we're going to see it swing back. And I agree, it's not going to swing back right to 15.5, Seth. But where do you stand in terms of this notion that maybe what the markets, I hate to say this, but maybe what's best for the markets is that we get this thing over with, rip the Band-Aid off, have the recession, have it short, have it done, and we know that stagflation is not a scenario.
Look, I mean, I just don't think that you can get really, really aggressive when you have a Fed that kind of has blinders on right at the moment, and they want to raise 75 in July, 75 in September. We'll see. They say they want to be data dependent, but they're so behind the curve. They got behind the curve, and now they're even more behind the curve. And like, they're not really seeing the real time. Here's what I want to say about inflation. Target and Walmart can discount all they want, and that's great for the consumer. That's great for the holiday season, by the way. But it's a small piece of the CPI. Rents, wages, healthcare, education, these are all very sticky parts of inflation. And so for those that are saying that we see peak inflation, I say, yeah, maybe it's at peak, but we are going to stay elevated for quite some time. And I think the core PCE deflator is much more important for the Fed and their decision making than the CPI. They look at the core PCE deflator and want it to be 2. It's going to come in at about 4.8%. So what if it comes at 4.5? That's still really, really high. And so they're going to continue to be very, very aggressive on rates as long as that number is really high. And not only is it, you look at CPI2, PPI, unit labor costs are also, the employment cost index. These are other areas that we have to keep an eye on. But inflation is going to stay very high for a very long time. And therefore, you do not want to own the long duration assets, the growthier stocks, and you want to continue to find the companies that are going to benefit from inflation. And those are the sectors I mentioned earlier.